Okay, in this video we're going to look at monetary policy and practice. So the goals of monetary policy is price stability, economic growth, price stability and full employment, stability of financial markets, interest rate stability, stability in foreign exchange markets. The inflation targeting is where the Fed or a central bank primarily focuses in on the rise in the price level. It targets inflation. It is less concerned with unemployment and GDP. Here's some examples of inflation targeting when it began in New Zealand, Canada, and United Kingdom. So you see inflation's all over the place in New Zealand. It's high in Canada, and then it's relatively stable in Canada, then it starts to accelerate. In the United Kingdom, it's pretty high in 81, then it reaches another peak at 10. So when the central banks of New Zealand, Canada, and United Kingdom started targeting inflation, they've done a pretty good job. They've kept it well below 5, it looks like. It looks like Canada seems to have the most erratic inflation. New Zealand, it looks like their inflation was pretty stable, but then it seems like it's starting to get a little more erratic. And it looks like the UK probably has had the best performance in terms of inflation targeting. The Fed, the US central bank, historically announced targets for money supply growth starting in 1975. Paul Volcker, in 1979, focused on the growth rate of non-borrowed reserves to push down accelerating inflation. Under Greenspan, growth rates of monetary guides were abandoned. Today, the Fed basically tries to prevent inflation from getting started. Since 2003, the discount rate has been a non-binding price ceiling on reserves. And so the Fed wants to change the discount rate without doing anything else. What simply happens is there's no change in reserves. The binding price ceiling is just raised. So if, for example, if before it raises the discount rate, if demand were to increase out to here, then the federal funds rate would rise up and equal the discount rate, because now it would be a binding price ceiling. In normal mode, where the demand for reserves crosses the vertical section of the supply curve, the discount rate is a non-binding price ceiling. So when the Fed raises the discount rate, the demand for reserves has to increase substantially more in order for the discount rate to become binding. So if demand doesn't change or fluctuates very slowly, raising the discount rate does nothing to the quantity of reserves in theory. Lowering the discount rate to the point where it's still non-binding has no effect on reserves. So raising and lowering has no effect on the equilibrium in this market, theoretically. That's assuming the demand for reserves doesn't shift wildly. What about changing the required reserves ratio in normal mode? All right. When you change the required reserves ratio, you change, in our model of demand, you change the value of the intercept, because the intercept, part of the intercept is the quantity of required reserves, the reserve required ratio times the quantity of demand deposits, right? So raising the required reserves ratio shifts demand for reserves outward. And if the effect is big enough, it essentially creates an emergency situation. Like, for example, here, increase in required reserves ratio from, say, 10% to 20% might push the demand for reserves out to the red curve. And at this new equilibrium here, the discount rate is now binding. In order to prevent the federal funds rate from going up to the demand curve, the Fed has to make this difference in discount loans. So 31 minus 28, 3. The Fed has to make $3 billion in discount loans to prevent the federal funds rate from going up to the demand curve. So that's how the Fed makes the discount rate a binding price ceiling in this case. Now, realistically, the demand curve for reserves fluctuates. And it fluctuates because under normal economic activity, demand deposits aren't static. Like, for example, maybe perhaps at the beginning of the month, people get their paychecks. And when they get their paychecks, everybody's demand deposit accounts, their checking accounts, increase. But during the month, as they draw down their accounts to pay for bills and whatnot, demand deposits tend to decrease. So you can probably, I suspect you'd probably see a spike in demand deposits near the beginning of each month when people get paid through direct deposit. So if the Fed does nothing as demand is cycling like this, interest rates will fluctuate. So the Fed has to constantly do open market sales and purchases, the New York Fed, to keep the interest rate, the federal funds rate, at its target. So the way it does this is when demand is high, it does an open market purchase to push interest rates back down to the target. When reserves demand is low, when it cycles low, it has to do an open market sale. So as demand increases, it's doing open market purchases. As demand falls, it's doing some open market sales. So the open market sales are when the Fed moves the supply of reserves leftward. And open market purchase is when the Fed moves supply curve rightward. And so in order to keep interest rates from moving too much in the federal funds market, it's constantly doing open market purchases and sales in New York. Okay. Now, if each oscillation in the reserves equals $100 billion and the multiplier is, say, 4, currently it's about 1, then each oscillation in the money supply equals $400 billion. So trying to keep the federal funds rate at its target causes money supply to oscillate. And if the demand for reserves is oscillating wildly, then you're going to see wild oscillation in the money supply growth rates. Okay, now suppose instead the Fed decides to target the money growth rate. And you got to remember, demand for reserves is not static, it's bouncing around. So the Fed is watching the growth rate of money supply rather than kind of keeping an eye on interest rates. So when the demand curve shifts outward, like right here, the demand curve shifts outward, we're assuming in this model that this movement from 28 billion to whatever this is, 29 billion, that no more open market purchases on net were greater than open market sales. Notice what happens to the federal funds rate. It rises above its target of 2, right? But then what happens when the demand for money collapses a little bit? So the Fed now has to do open market sales that are on net much bigger than open market purchases. And now look at where the interest rate is in the federal funds market. It's at 3 and the target is 2. And this difference here, this change in reserves here, was intended to smooth the growth of money. And then here we have demand for money shifting again, and the Fed doing open market purchases that are larger than open market sales. And this pushes the interest rates down below the target to maybe 1.9%. And again, this positive change in reserves was intended to keep the money supply growing at a nice steady pace. And this will just continue, right? Now the demand for reserves is really high. The Fed had to do an open market purchase that exceeded the open market sales it's doing. This difference here was intended to kind of smooth the growth rate of money. And so you can see that when the Fed targets money, interest rates are kind of bouncing around. And you see this during the Volcker years. You see interest rates varying widely in a large band. So when reserves are grown at a rate that grows the money supply at its desired rate, the federal funds rate will fluctuate wildly. And you see this actually in the data like I mentioned. Now we're not in normal mode. We're in what's called what I call crisis mode, where the demand curve for reserves has been kinked by the Fed setting a binding price floor on reserves, and it's called interest on reserves, IOR. And when this happens, when the Fed has interest on reserves and it's binding, the demand for reserves kinks. So let's look at what happens to the federal funds market when the Fed simply lowers and raises the discount rate. When the Fed announces a new discount rate and it doesn't do anything else, assuming the demand curve is not bouncing around too much, the quantity of reserves in this market will stay about the same, 28 billion, theoretically, right? If the Fed then lowers the discount rate, theoretically, it's not going to change the quantity of reserves. Now, you can imagine the demand curve could be bouncing around right here, right? As long as this part of the demand curve oscillates in a narrow band, like from here to here, and doesn't oscillate out to here where it would intersect the vertical section of the supply curve, small oscillations in the demand curve due to fluctuations in demand deposits will not affect the quantity of reserves. Okay? Now let's look at what happens when the required reserves ratio is raised. When the required reserves ratio is raised, say substantially from, say, 10% out to 20%, the demand curve will shift out to here. And this has been so extreme that it now intersects the horizontal section of the supply curve. It could have shifted out to this point here, right? Could have shifted out to here where maybe it intersects the vertical section of the supply curve. But in this example, it shifts out and intersects the horizontal part of the supply curve. So in this situation here, the required reserves ratio being increased causes kind of an emergency situation where banks now need to borrow from the Fed, and total amount of borrowing will be about $1 billion here, right, to meet the new reserve requirement. And then, as we learned before, when something like this happens, it can actually decrease the quantity of money substantially, and as a result, increase interest rates, which would lower investment expenditures and exports, and maybe push aggregate demand from maybe it was at full employment, or maybe it was in an inflationary gap. It can actually collapse aggregate demand into a recessionary gap. So normal fluctuation. This is what normal fluctuations look like in the federal funds market when we're in crisis mode. Demand oscillates back and forth, right? Demand oscillates back and forth because checking account balances oscillate during the course of the month, right? So when demand is high, maybe that's when demand deposits or direct deposits are made from employers. And when demand is low, maybe that's when, as demand falls during the month, it's fallen because people are using those checking account balances to pay bills throughout the month. So with the interest on reserves set as a binding price floor, the federal funds rate and quantity of reserves won't change theoretically. Now I'm going to show you how open market operations don't change the federal funds rate like they do in the normal mode. With demand oscillating very little, or normal fluctuations in reserves demand, there's enough excess reserves where the Fed can do an open market purchase and move the supply curve over here, or do an open market sale and move the supply curve back over here. So I'll show you how that works. So demand is oscillating here because checking account balances oscillate. They rise, they spike right when people get their paychecks, and then during the month, as their balances are dwindle, as they pay bills, demand will shift in. So I did it again. So demand for reserves is oscillating, right? Over here, the Fed is doing an open market purchase and then a sale, open market purchase, then a sale, open market purchase, then a sale. And so theoretically, that'll have this these open market operations with a fluctuating reserves demand will have no effect on the federal funds rate, but will change the quantity of reserves. The discount rate and interest on reserves can be raised together without affecting the quantity of reserves or the money supply. And the way this works is, assuming demand is constant, the Fed can simply issue a dictate that says the federal funds rate target via the interest on reserves and the discount rate are just simply higher, and it can continue doing this. Now when it does this, if you think about this point all the way straight down compared to this point, that difference is excess reserves, because this interest on reserves is serving as a binding price floor. And as the Fed raises interest on reserves and at the same time raising the discount rate, it's increasing the distance between this point and that point, given a static demand curve for reserves. So you can see as the Fed raises interest on reserves and the discount rate, it can increase the size of excess reserves, money that is not lent out. And the reason why that money is not being lent out is because, well, I mean, if you're a bank and you have money you can lend to a consumer, a business, or the Fed, who are you going to lend to? Are you going to lend to the Fed at, say, 3.5%? That's a pretty sure bet, right? In crisis mode, the Fed has essentially created a liquidity trap with when interest rates were like really, really low at, say, 0.2%, the federal funds rate. When that was the case, then the discount rate was 1.2. The discount rate's a non-binding price ceiling. Interest on reserves at 0.2 in this model is a binding price floor. And the difference between this distance, or this value here, which might be 26, and this value here, which is 28, that difference is excess reserves, or what I like to call is unemployed reserves. Now, if the Fed does an open market purchase here, the quantity of reserves increases. If demand's static, the quantity of excess reserves also increases. So reserves are increasing because excess reserves are increasing. And as long as demand is static, not shifting too much, the excess reserves, the distance between the horizontal distance between here and here, will continue to increase as the Fed does more open market purchases. And this probably explains why the money multiplier dipped below 1 and hung out below 1 for many years post 2008 financial crisis. So the federal funds market is in a liquidity trap here. Banks, instead of making loans to businesses and consumers, they're just making loans to the Fed. They're not making loans to other banks, they're just making loans to the Fed because the Fed is paying 0.2%. If they lent to a bank, the equilibrium might be down here in negative territory, right? So instead of lending to another bank at negative interest, they can lend to the Fed at 0.2%. So with the Fed in a liquidity trap, it's kind of hard, I think, for the Fed to target money. Okay, so the last one we're going to talk about in this video is the Taylor rule, and we're going to kind of incorporate it with the non-accelerating inflation rate of unemployment, or the natural rate, and the Phillips curve. This data for this particular example was collected for a Federal Reserve college challenge, a team that I coached. I think we went to the Fed challenge in October, November of 2008, and so this was our analysis for the Fed challenge, and we decided to use the Taylor rule to make a recommendation on interest rate policy right around the election in 2008 and the financial crisis at that same time. So in September 2008, the unemployment rate was about 6.1%, and the trend in the red line suggests that unemployment's on the rise. And when unemployment's on the rise, usually a recession has already happened. The NBER didn't date the start of the recession until, I think, December of 2008. The blue line says inflation, which was even higher in a previous period, a previous month. Looks like maybe it was on its way down. The inflation rate was about 4.9% in September 2008, and looks like it's headed down. Then the green line is economic growth, and it was about 0.8% in September 8, and it's pointing to recession. And you can see that during the recession, the economic growth rate reaches its lowest point. So it's headed toward negative territory, it looks like. Now this is the Augmented Phillips curve, the Augmented Phillips curve that we came up with. The data points here are the change in the inflation rate, not the percent change, but just the change in the inflation rate from the previous year versus the unemployment rate. And so what this graph demonstrates is how inflation will change for a given level of unemployment. So suppose the Fed expects future unemployment to rise to 8%, right? Which is not an unreasonable assumption back in September 2008, because what was unemployment doing? Unemployment was going upward, right? So if unemployment continues to rise to 8%, which it almost got to back in 1993, 1992, 1993. So if unemployment rises to 8, and I think it ended up at 10% in the spring of 2009. So just in about 6 months, it ends up at about 10. So the Fed expects unemployment to rise to 8%. Then this red line says that inflation should fall by about 1.6 percentage points. So if the red line hit here, inflation would fall annually by 1 percentage point. If the red dashed line hit here, then inflation would decline by 2 percentage points. But it's somewhere in the middle. So the red line is saying that inflation we expect inflation to fall by 1.6 percentage point. Okay, so what we did then is with GDP inflation at 2.6%, we expected inflation to fall by 1.6% because we expected unemployment to rise to 8%. That would put the inflation rate at 1 percentage point, or 1%. Now the red line represents potential GDP, and the blue line represents real GDP. And you can see that we had the great times of the 1990s, and then we went into a recession, and GDP fell below potential GDP, and it kind of remained there all throughout the Bush years. And then in September 2008, it was going south. So you can say with this data that we were probably in a recessionary gap for much of the early 2000s to late 2000s. Before the recession of 2001, it looks like we were in an inflationary gap. So suppose the Fed expects the gap to continue to widen. So in January 2009, we said we expected the gap to get even wider. And it actually got really wide. It's in my book, my macroeconomics book. This graphs with updated data is in my macroeconomics book. Thus, we projected the GDP gap at negative 3.5%. And it actually dropped quite a bit, and then it kind of hung out there for a while until they revised how they calculated GDP and revised potential GDP's trend line. Okay, so we expect a gap of 3.5 percentage points. So the way the Taylor rule works is, and there's a lot of different Taylor rules, this is the expected gap, and we said it was negative 3.5%. And the Fed's inflation target is 2%, so that's kind of fixed, right? And then the equilibrium interest rate, we did a little research on it. We figured that was probably about 2%. And then expected future inflation, via the GDP deflator, we probably should have used the what the Fed uses, the PCPI, Personal Consumption Expenditure Price Index, less energy and fuel. But we used the GDP deflator, and we expect that to be at 1%. So when you plug these numbers into this Taylor rule, we predicted that we recommended that the Fed set the federal funds rate at 1%. And in reality, that's actually kind of what happened. The Federal Reserve set interest rates pretty low. I think in November, I think the federal funds rate was about 1%. And then by January, they had it down in a small band of like 0.15 to 0.25%. So we were pretty accurate. We didn't win. We didn't even place. So some people think that the Fed uses a Taylor rule, because if you look at the Taylor rule through time, that's the red line, and then the federal funds rate kind of is pretty highly correlated with the Taylor rule. So, and you can see in 2008, probably late 2008, the federal funds rate was about 1%, where we had recommended they put it, and then they pushed it even lower to basically 0%.